bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the July 22nd, 2025 episode. As those of you watching on YouTube can see, my guest today is my partner, John DeJovine, who works out of our Cleveland, Ohio office. John is here to talk about financing affordable housing with a combination of both historic and low-income housing tax credits. John is an expert, as you'd guess, in both those tax credits. More specifically, John was the lead editor of our most recent edition of the Novogradac Historic Rehabilitation Handbook. John is also the chair of the Novogradac 2025 Historic Tax Credit Conference this October, also in Cleveland, Ohio. John also has an extensive low-income housing tax credit practice. And for me personally, combining low-income tax credits with historic tax credits is really a combination of the two areas that I worked on initially at another accounting firm before starting Novogradac back in 1989. More specifically, I started working with historic tax credits before the Tax Reform Act of 86, and then started working with low-income housing tax credits after the enactment of the credit back in 1986. So this is a blend of two of my first loves.
Love to hear
it. And when I do think of the transactions I have worked on, and I think about combining historic tax credits with the low-income tax credit, I think about the clients generally falling into one of two categories. There are those that are affordable housing developers that are used to working with the low-income tax credit, and they find a development that they're renovating that actually is also eligible for historic tax credits. So they're new to historic tax credits in that scenario. And then the other scenario is the complete opposite, where you have developers who really focus on preserving historic buildings in various communities throughout America. And they find a development that's particularly well suited for rental housing. And then they end up investigating affordable rental housing. And then they come and they say, let's layer in local tax credits. During the course of this podcast, we're going to be more focused on the low-income housing tax credit developers using historics for the first time, because they do, in my experience, we'll get John's thoughts later on his experience. It's generally the affordable housing layering in historics as opposed to the opposite. But the podcast will be relevant for both types. And I don't have too many clients that regularly are combining both. There's obviously a lot that we are going to be able to discuss today. So if you're ready, let's get started. John, welcome back to Tax Credit Tuesday. This is your fourth appearance, but it's your first since last August. So hopefully you won't stay away quite so long next time.
Mike, thanks for having me. I'm very excited to be back, and I will make an effort to get back here as soon as possible.
Thank you. I always like to start the podcast having my guest share a bit about the services they provide to Novogradac clients. So this is your opportunity to do that.
Thank you, Mike. So most relevant to what we're talking about today, I do quite a bit of historic tax credit and LIHTC consulting and financial forecasting at the front end of these deals. So helping developers go through the initial numbers, help with feasibility, and then doing financial forecasts that reflect the entire transaction. I also do that type of services for the new market tax credit opportunity zones. And then apart from the forecasting and consulting, I also do quite a bit of work doing cost certifications and audit and tax work for LIHTC historic and new markets clients, both from the developer and from the syndicator standpoint.
Great. Thank you for that. And I will include your email address in the show notes for those that want to reach out to you after the podcast. So I mentioned in the introduction that my general experience when I'm working on development that has both credits, that it's generally a luxury tax credit developer that's renovating a building that's historic, and they're layering in the historic tax credit. Is that your experience, or is yours a little different?
So I'd agree with your perspective on that, Mike. And that's what I most typically see is that you've got a LIHTC developer they've got the project that, fits well with historic tax credits, and they're planning to layer that in. I think that you see it more from that perspective because getting up to speed as a LIHTC developer, I think is a little bit more time intensive and work intensive. Getting familiar with state agencies and how the credits get allocated can be a little bit more time intensive. Whereas the historic tax credit is a by right credit. So if you meet the requirements of the program, you can get the credit. Additionally, some of the compliance requirements that go along with the low income housing tax credit, like maintaining rent and income compliance throughout the 15-year compliance period, I think can be difficult for just a one-off development. So I think those are some of the key reasons that I see it more a LIHTC developer layering on historic tax credits.
Great. Thank you for that. In that scenario with a LIHTC developer layering in historic credits, they're doing that for a variety of reasons. One may be that in order to get the various development approvals and the rest, you need to agree to retain the historic character of the property. Another is looking at the historic tax credit as an additional tax credit to raise additional amounts of tax equity to help make the project financially feasible. So if I'm a LIHTC developer listening to this podcast and I have a renovation project where I'm considering applying for or going through the process of claiming historic tax credits, what should I be thinking about in terms of the role it plays as a gap filler, as a source of additional equity?
Sure. So the first thing to be aware of, and a lot of developers may know this, but the historic tax credit is a 20% historic or a 20% credit calculated based on the amount of qualified rehabilitation costs that are incurred. So right off the bat, you can get an additional 20% credit for costs that you incur that you might otherwise be incurring if you were just doing your LIHTC improvements. And we'll talk a little bit about calculating that basis later. In addition to that 20% credit, there's now 39 states that have state historic tax credit programs. Those state historic programs vary greatly. You want to be aware that some states are by right, where other states have a cap on the amount of credits that are eligible for the entire state, and some states limit the amount of credits that specific projects can have. But this can be an excellent addition to a project that is going to get the federal credit. If they can also get the state credit, that can really add a lot of equity to the project and be a gap filler, or just make the whole project a lot more feasible.
So that sounds straightforward. Seems like, okay, I get additional equity as a percentage of my various costs. Share some of the additional costs associated with going through the historic tax credit generation process.
Sure, Mike. So first of all, to be eligible for the historic tax credit, you need to have a building that is listed on the National Register or is deemed to be contributing to a historic district. And if it's not already, that might be a process that you need to go to. There's some cost and time associated with that. So you want to be aware of that first. And to that point, I'll note that there tends to be some projects out there that you wouldn't necessarily think would qualify as historic projects.
Yes.
But may be. So it is worth exploring with your historic consultant or having some conversations on it. There's some public housing developments out there or office buildings that may not seem like they would qualify, but may be able to add this additional benefit. Next thing I'd want to note is that there's a substantial rehab test for historic tax credits. There's also one for low income housing tax credits if you're doing a rehabilitation of one. But the LIHTC substantial rehab test is much lower than the historic tax credit substantial rehab test. For historic tax credits, you need to incur qualified rehab expenditures equal to 100% of the basis of your building. And so you may have situations where your LIHTC, the improvements that you would be doing in your LIHTC project may not be enough in order to get the historic tax credit and meet this historic tax credit substantial rehab test. So did want to flag that for folks. Most of the times you would be able to pass this, but there may be times when you have a really high acquisition value that you may not be able to pass this. Some of the other costs that come along with adding historic tax credits onto a LIHTC project would be going through, the MPS process, like I had noted, overall additional legal and accounting costs that could be present when you layer on historic tax credits. And then also just additional rehabilitation requirements that may be required by the National Park Service and the State Historic Preservation's Office. A couple that we see is they may have particular requirements for windows and not replacing certain windows. So in a LIHTC project, it might be more advantageous to go through and just replace windows, where if you go through and want to claim the historic as well, you may have to do this in a particular way, and this may add additional costs to the overall project. And there may just be some design aesthetics associated with doing it as a historic project that could add additional costs. Generally, we'd see this, the historic credit would greatly outweigh this, but it should kind of just go into the calculus if you're adding on the credit and what the overall value will be from that.
Yeah, I sort of think of it as a gross versus net equity as a gap filler. The gross equity dollars that you get from the federal credit, and then obviously if you're successful or in a state that has state credits, it'll be that gross equity that you'll get from doing an historic renovation will be that much higher. The net equity piece is, well, what additional costs am I incurring? Because I do incur additional costs. And then identifying the net equity. And the net equity conceptually is the amount that helps with the financial feasibility, helps as a gap filler. And then obviously this is, when your ability to do it as an historic renovation is optional, as opposed to being mandated for one of a variety of reasons. Now, one nuance of the historic credit, which is different than the low-capacity tax credit, is the historic credit has a basis adjustment. The low-capacity tax credit does not have any basis adjustments. When you claim the credits, it does not affect your depreciable basis. When I think about combining historics and low-capacity tax credits, many listeners and viewers are probably thinking, well, I've got a low-capacity tax credit partnership. I've done maybe solar before, and I claim solar at the partnership level. Oftentimes it flows through to my investors, so on and so forth. There are the 45 CAPL credits, which are now going to be extinct in a year for energy efficiency, and they flow through to my investors. The historic credit, if I think of that, and I think of this as like a direct, if the project itself is incurring the historic renovation costs, it claims historic credit. There's this basis adjustment equal to the amount of credits. And that basis adjustment ends up reducing your eligible base for purposes of calculating the amount of low-capacity tax credits you're eligible for. So there is this, in a sense, this cost potentially associated with claiming the historic credit that could reduce your low-capacity tax credits. So I've tried to explain that fairly straightforwardly. I'm not sure how effective I've done. Maybe listeners or viewers can shoot me an email or something, let me know how good that explanation was. But with that said, there are structuring alternatives or a structuring alternative that a developer can consider to address this basis adjustment impact on my low-capacity tax credits. With that as introduction, please explain a little bit more about the basis adjustment and then the structuring alternative that exists and is often used.
Great. Thanks, Mike. That was a good explanation. Nobody needs the email. It was good. All right.
Thank you.
So when I think about historic tax credits, there's two key structures that we typically see. The first is kind of what you were alluding to, I think, is the direct structure, when you have one partnership, that partnership owns the property, any debt is to that partnership, and your investor is a direct member of that partnership and typically owns 99%, or in the case of a LIHTC historic deal, owns 99.99%. So in one of these structures where you have the direct structure and you'll be taking both the LIHTC and historic all flowing to one investor, typically the pricing on the historic tax credit tends to be stronger in those types of transactions. And additionally, the deal tends to be looked at as just more of a traditional low-income housing tax credit deal with the historic tax credit as a sidecar to it. And with historic tax credits, there's some safe harbor rules that I won't go into that are under Revenue Procedure 2014-12. And typically when you do this direct structure, oftentimes you won't follow those safe harbor rules necessarily because this is being viewed more as a direct LIHTC deal. But as you noted, one of the key points when you're combining LIHTC and historic in the direct structure is that you have this basis reduction. And so you will have you have your 20% historic tax credit, but that 20% historic tax credit also serves to reduce the basis of the building by that tax credit amount from both the depreciable standpoint and for calculating the LIHTC basis. So that's a key thing to know, that you could potentially have less low-income housing tax credits in a direct structure where you're combining historic and LIHTC. But the type of LIHTC the type of low-income housing tax credit deal that you have can affect this significantly. So if you have a 9% LIHTC deal, in this case, where you're combining it with the historic, typically well, not typically, but oftentimes a 9% LIHTC deal may be capped on the amount of low-income housing tax credit they're able to claim. And they may have excess eligible LIHTC basis that having this basis reduction doesn't actually affect the amount of 9% LIHTC credits that the partnership would be able to claim. So in the direct structure with the 9%, oftentimes the historic pairs very well because you don't have this basis reduction and you're claiming exactly the same amount of 9% credits that you would otherwise claim because of that excess basis. Where you run into more issues is if you have this direct deal and you have a 4% deal, where 4% deals typically aren't capped on the amount of low-income housing tax credit that a project is able to generate. And so in that case, you're going to have a reduction in the eligible basis by the amount of historic tax credit that the project will be eligible for. Overall, the math still works out that you are getting a net benefit with that reduced amount of LIHTC credit, whatever that little amount of reduction is from the historic tax credits. And with the historic tax credits, you still end up with overall more tax credit equity. But you want to be, aware that you're going to have that when you're doing your underwriting, and also just taking this into account for, what other costs are going to go along with that, and making sure that you've correctly calculated what net benefit you're going to get from your tax credit in this direct structure.
I just wanted to interject here before you move on to this other option that just highlights the importance of running the numbers with respect to the structuring, so you are optimizing the financial resources available, since very few transactions have excess sourcing such that you don't need to be focused on trying to generate more sources. Virtually all transactions have some level of deferred developer fees, some type of gap financing that you're trying to close. And it's a constant effort even before you deal with cost overruns. So it is something that there's no easy answer here, as John's clearly demonstrating, but please continue.
Sure. Thank you, Mike. I think that was a great point. So we just walked through the direct structure and how you have that basis reduction. So this second type of structure that you see for historic tax credits is what's called the lease pass-through structure. And so in this situation, you have two separate partnerships. One partnership owns the property and any debt would be at that partnership. The second partnership leases the property from that entity and then operates it. And so in this case, you'd have those two separate partnerships, and having that lease in place between what's called the landlord that owns the property and the tenant who leases it. Having that lease in place allows you to pass through the historic tax credit from the landlord to the tenant. So when you do have that structure, you typically have two separate investors. You have the low-income housing tax credit investor who invests in the landlord entity, and then the historic tax credit investor who invests in the tenant entity. Those investors must be different underlying investors. There's some rules with that lease pass-through structure that don't allow the same investor to invest in both sides of the landlord and the tenants. But if you do have, if you are able to execute on this structure, you can avoid that basis reduction. And when you have that 4% deal, you're able to generate the full amount of the 4% credit and the historic tax credit as well, and can really add some, additional equity to the project that may be very helpful. But there are some other issues that you need to consider when you're trying to execute on a lease pass-through deal with low-income housing and historic tax credits. First is when you have two investors, you're going to have additional costs that go along with having both of those investors from a legal perspective, audit and tax perspective, et cetera. Next, for your historic tax credit investor, you're going to have to follow all those safe harbor rules that I noted earlier for that historic tax credit investor. And often that means having priority return distributions and a put payment that would go to that investor and can reduce the overall cash flow that might be available to the project. And the final one is just overall investor appetite and pricing in these structures. So it is difficult to be able to execute on these structures, find both a LIHTC investor and a historic investor that are willing to go through, some of the additional work and effort and compliance that goes along with these structures. So it really does take the right deal and the right developer and the right deal size in order to do this lease pass-through structure. But when there are certain times where it absolutely adds significant amount of equity to the project and can really be that gap filler and help these projects work out.
Yeah, and I also feel like so much of this is a function of what the size of the transaction is relative to the potential benefit of avoiding the basis reduction. And I would just add to listeners who are sort of wondering why this concept even sort of exists, because when we describe it in the context of a monthly tax credit transaction, sometimes it can seem a bit arcane, but it is something that Congress created by statute. And the way to sort of envision it is in a very basic way. You can envision a developer just developing, any building, generating historic credits, but then the developer themselves not having enough tax liability to use those credits. And then the developer, wants to try to monetize those credits. And Congress basically said, look, if you have a tenant in your building, you could pass through credits to a tenant in the building. And that's what this structure is using this provision that allows the developer to pass through the credits to a tenant of the building. And obviously in this situation with long-term tax credits, that quote tenant is master leasing the entire property. And I would also note that it's not as if this basis reduction just vanishes. There's something called 50D income. And a friend of mine, Herb Stevens, longtime attorney, now retired, he used to call it anti-depreciation. And it's basically where you take this basis adjustment that isn't being recognized, and the investor that's claiming the credits ends up having to recognize income as if they were not getting depreciation expense. And I'll leave it at that. I don't know if you wanted to say anything more about that, John, but I'm happy to let it lie right there.
No, I think that's fine. And I appreciate all that perspective, Mike. And this is the benefit of having someone who's been able to see the historic tax credit from the very beginning, being able to bring all that perspective. So thank you.
So thank you for that. Now, staying with this perspective of a luxury tax credit developer using historics for the first time, or at least not frequently, there are additional tax issues that arise. So please describe for the audience some of the additional tax issues that arise, or some of the sensitivity to tax issues that arise in both circumstances, but are a lot more relevant in an historic tax credit situation.
Sure. And I've had these conversations many times with LIHTC developers, and they're used to the specific tax rules that they see in their LIHTC projects, and they kind of have to factor in these different rules for historic tax credits. And the first one I'll start with is that the historic tax credit is allocated based on a profits allocation, where the low-income housing tax credit is allocated based upon how depreciation is allocated between the partners. So this is a key one that developers and investors alike need to keep in mind with how they're writing their operating agreements, and ensuring that those profit allocations are staying consistent during the 5-year historic tax credit compliance period. And so the historic tax credits will flow the way that they're intended to. And we'll often see in these deals that the partnership agreement states that profit allocations will go in this certain manner for the 5-year historic tax credit compliance period. And then after that time period, passes, then they're able to do maybe a 90-10 split with developer and investor. So that's one to definitely keep in mind.
Let me actually just interject there that, it's always interesting to me that the investment tax credit that Treasury in essence decided that the investment tax credit would be allocated among investors based on profits. And this was decided over 50 years ago. And well, since the decision for investment tax credits to be allocated based upon profits, a whole series of partnership allocation rules came into being, and they, as a general rule, say you allocate a tax credit based upon how the cost that generates the credit is allocated. So with luxury tax credits, the depreciable property generates the eligible basis that generates the credit. So how depreciation is allocated in a luxury tax credit transaction is how the luxury tax credit is allocated. So you're very focused on the allocation of the expense. And I could go through a number of other situations where the credit is based upon the allocation of the underlying expense. Could be, work opportunity credit, things of that nature. But the ITC sort of stands out there on its own as a profits interest. And the unique aspect of dealing with that is in a LIHTC development, you actually don't expect any taxable profits because of the depreciation expense. So the whole concept of a profits interest can be a bit ethereal. More than listeners wanted to know on that topic, but please go on to additional tax issues.
Not more than I wanted to know. Mike, I love it.
At least you and I are enjoying the podcast.
So the next one I wanted to cover was tax-exempt partners. So tax-exempt partners are a consideration for LIHTC projects, and the amount of depreciation, and of course the 168H election is often in place in these LIHTC developments if they have tax-exempt partners in order to maximize depreciation. But I'd say with historic tax credits, it's even more relevant. Because the way the historic tax credit rules work is the any allocations that would go to a tax-exempt partner, and that this is based upon the highest allocable share that would be allocated to a tax-exempt partner during the entire life of a partnership, can create tax-exempt use property. And any of the property that's deemed to be tax-exempt use property reduces the amount of historic tax credit that would be generated by a project. So in these LIHTC projects, if you have tax-exempt partners that are going to be involved, it's very important to flag that earlier and make sure that the structuring is done in a way that it won't create tax-exempt use property and reduce the amount of the historic tax credit.
Great.
The one other tax issue that I wanted to note was the at-risk rules. The at-risk rules are part of Section 49 of the Internal Revenue Code, and they have to do with the amount of non-recourse financing, and if there is if there's non-recourse financing above 80% on a project, or if you have non-qualified non-recourse financing, it can reduce the amount of historic tax credit that may be eligible to an investor. Oftentimes in LIHTC historic deals, you have partners that are widely held C corporations, and widely held C corporations are not the at-risk rules don't apply to widely held C corporations. So oftentimes this may not come into play in these LIHTC historic deals, but it's something to certainly keep front of mind and make sure that there's no issues with that. And then one other thing I did want to note that is not a tax issue, but is something that LIHTC developers should be aware of, and something they wouldn't maybe normally see is SNDAs, which are subordination and non-disturbance agreements. So in historic tax credit deals that are lease pass-through deals, typically the historic tax credit investor is going to require a subordination and non-disturbance agreement. And this is an agreement that a lender will not disturb that lease that's allowing the historic tax credit to pass through from the landlord to the tenant. And the lender agrees to that SNDA, and that SNDA gives the historic tax credit investor assurance that their tax credit won't be affected during the 5-year compliance period. So this is something that, I point out to historic tax credit clients early on to make sure that they're talking to their lenders about this, and making sure that they're aware and, can be relevant in these LIHTC historic deals as well that are using the lease pass-through structure.
Great. Thank you for that. And we could chat more about other sort of tax issues, but I agree that those are some of the key tax issues that are unique, as well as the business issue of the SNDA. Let's cover one other topic, and then we'll bring the podcast home. And that has to do with calculating the basis for which credits are claimed as a percentage of. And it's one thing to say, your eligible basis is your depreciable property for LIHTC, and there's a whole host of calculations there that, we're assuming that the audience is familiar with the law of the tax credit, its rules. The historic tax rate, you already pointed out, you claim the 20% as a percentage of your qualified rehabilitation expenditures, your QREs. And it is a credit that's claimed over 5 years. Used to be claimed when you place the building in service. Now it's claimed over 5 years. We were hoping to get it changed as part of the One Big Beautiful Bill, but weren't successful. But the definition of qualified rehabilitation expenditures has some similarities to the calculation of depreciable basis versus of long-term tax credits, but there's also some differences. So if you could highlight just a couple of the similarities and a couple of differences, and the real takeaway for the audience is that you need to be working with someone who's got a lot of expertise here. And at the end of the day, there'll likely be some sort of required cost certification by the historic investor, if they're doing a pass-through lease deal, in order to get comfort that the amount of credits they're claiming are supported by the underlying documents.
Sure. So I will start with similarities. So From a construction cost perspective, as long as all the improvements are to the historic building itself, then most of the construction costs are going to be both the same as eligible for the LIHTC as for the historic tax credit. And so those are, the true construction costs to the building. But there are going to be differences for site work and FF&E. So site work and FF&E is typically eligible for a low-income housing tax credit project. However, it is not eligible for the historic tax credits. Another similarity between the two is soft costs and carrying costs. So for the most part, costs related to the rehabilitation, so that could be architect and engineering, and then carrying costs like real estate taxes and insurance, and then interest that is paid on the loans that can be capitalized to the building. That will also be eligible for both the LIHTC and for the historic. And then a couple other differences between them. So for the low-income housing tax credit, there's the ability to claim the LIHTC on the acquisition, where there is no credit for historic tax credit on the acquisition. It's just on the improvements to the building. And then one overarching note that I wanted to make is for a typical LIHTC project, you may be thinking you'll do a cost segregation, which will identify costs that you've incurred and be able to identify costs that you've incurred that could be depreciated over a shorter life and take bonus depreciation on those costs. And this is something that's generally not encouraged on historic tax credit deals, because this can take things that might be eligible as historic tax credit, and it might be giving them it might be identifying them as shorter lived assets that would potentially create less historic tax credits. So you want to be cognizant of probably not doing cost segregations on deals where you have both historic and low-income housing tax credit.
And I would just note that, as we talked about in preparing for the podcast, that the interest expense that has to be capitalized, but it's associated with carrying the underlying building, that interest portion is not eligible for the historic tax credit. Okay. So I assume you agree with that?
I do agree with that. Yes. So if you have a loan and that paid for the acquisition of the property and there's interest related to that, typically that's not included as QRE.
And I would, in terms of the cost segregation study, I would just say that to amplify your sort of comments is oftentimes in a LIHTC transaction, there's a real focus on tax losses earlier in the process to generate a better yield for investors. So a lot of attention, a lot of detail goes into analyzing the what's personal property versus what isn't. And there's a real value there. When you're doing an historic renovation, you look at it, you say, well, if it ends up getting capitalized and it's in my renovation costs, then I'm going to get a 20% credit, but obviously I'm going to depreciate it over a longer period of time. If it is personal property and I'd otherwise expense it, it'd be more valuable as a deduction, but I wouldn't get the historic credits, and the delta between personal property and being a qualified rehabilitation expense isn't that dramatic. So the notion of going in and doing a cost segregation study and all the rest for most developers seems like an extra expense that isn't worth the benefits you might get from, a considerably more detailed sort of analysis. And with that, let me thank you, John, for being on the podcast today. As I noted earlier, I'll share your email address in today's show notes for those that want to reach out to you. I'm also going to share links to our Historic Rehabilitation Handbook, as well as a form to register for a Historic Tax Credit Conference this fall in Cleveland, Ohio. I will note that the National Trust for Historic Preservation is celebrating a key anniversary. So I hope you can join us there to help celebrate the National Trust for Historic Preservation as well. And before we get to the off-mic section, I'd like to encourage our audience to subscribe to this podcast if you don't already. I also encourage you to share the podcast with your colleagues who may be interested in this or other topics that we cover on the podcast. And those of you watching on YouTube, I'd also like to ask you to like and comment on the video. All of these help raise the visibility of the podcast so others can tap into the important discussions that we have, like the one we had today. And with that, we're now in our off-mic section. And our regular listeners and viewers know that we like to use this space to give a shout out to someone working in one of the many areas that we at Novogradac focus. And with that, John, who would you like to give a shout out to this week?
Thanks, Mike. Hey, before I do that, I wanted to take 1 second to recommend again that people definitely come join us in Cleveland for the Historic Tax Credit Conference. I think it's going to be beautiful that time of year in October, and really looking forward to hosting it in my hometown, Cleveland. And on that note, I wanted to recognize someone from my hometown, Cleveland, and that's Chad Arfons. He's an attorney with McDonald Hopkins, and I've worked on many deals over the years with Chad, and particularly I've worked in a lot of historic tax credit transactions that had tax-exempt partners in them. And Chad does an excellent job both working through the technical aspects of those transactions when you have tax-exempt partners, and they can be challenging transactions. But he also goes above and beyond for his clients. When you have tax-exempt partners, they may not be used to some of the tax and compliance issues that go along with those. But I see him on every transaction really go above and beyond for his clients, make sure they understand the relevant factors for them, and really help them benefit the most from the historic tax credit. So I'm glad that I get to work with Chad, and appreciative of all the work he does for the transactions we work on together.
Thank you for that shout out, John, and my shout out as well, Chad. Thank you for all that you're doing in this space. And with that, let me thank you again, John, for joining me on the podcast. And for the viewers and listeners, thanks for signing in this week.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast, or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.